Great. So in today's section, we said we are going to look at for two items, IAS 10 and IAS 12. So let's start with IAS 10, International Accounting Standard number 10. It talks about event after reporting period. So IAS 10, that is events after the reporting period. Event after event after the reporting period. After reporting period. I normally call it EARP. So event after reporting period. Basically. Now, event after reporting period talks about the transactions and events that normally happens after the reporting period. So in summary, let's just assume that our financial year starts at January. Why do you think it will end? By December, and then it will end there. Okay, so by December, if our financial statement starts, our financial year starts at January, by December, that is our reporting period, right? So our financial year starts here, January, and we end at the December. So when do you think they will prepare the financial statements? I'm just assuming that this is 2019 financial year. That means they prepare the financial statement as a third exam preparation dates. So this is where they'll prepare the financial statement. So let's put preparation date there, P. So the financial statement is prepared right at the end of the reporting period. The last day they prepare the financial statement, usually the 3rd December. If I use September, then 20th September in that order. Then, when do you think you publish this financial statement for public consumption? After the preparation, the next day, right? Or the next month? After they have prepared the financial statement, when do you think they will publish this financial statement? Okay, so 3 months after. So ideally, by the end of next 3 months, so somewhere ending of March, the financial statement should be ready. So you're going to issue it, issuing dates or publishing dates. So you prepare the financial statement December and you publish it March so that the general public will have access to it. Now the question is, between December and March, transactions and events, okay, how do you treat them? So transaction that normally take place between the preparation date and the publishing date is what we refer to event after reporting period. Now it has 2 features. The event will occur after you have prepared your financial statement. At the same time, just that before you publish them, how do you get it? If the event takes place after the publishing date, that is not event after reporting period. The event must probably take place before you publish the financial statement. So after publishing, no, that one, IAS 10 does not cover it. That's all. So in short, event after reporting period just represents favorable and unfavorable events which take place between the date at which the financial statement is being prepared and then the date at which the financial statement is being published. So preparation dates Let's say March. That is the publishing date. Good. So this is what we refer to as what? Event after reporting period. That is all. Formally, we call it event after balance sheet date. And then came to event after reporting date. Then we have event after the reporting period, basically. So that is the section. Now, any transaction which will take place here, we should call it event after reporting period. So that is all. So in short, it should have two features. That event should occur after the preparation of the financial statement, but before what? The publishing. That is all, before the publishing starts. If that transaction probably takes place around April, they're going, that is not event after reporting period. No, because the financial statement itself is an issue. So it will not create any adjustment. Okay, so sorry about that. In short, we said that the adjusting events, they are events after the reporting period that provide evidence of its existence before the year end. Let me go back small because of the issue. So we are saying that if this is December, our financial year starts from January, we will publish our financial statement around this year, around let's say 31st, let's say March financial statement published. So the transaction took place here. By then, we've already prepared our financial statement. So we are saying that it will be adjusting if it will provide evidence that it exists before the year end. That is all. Good. So adjusting events are events after the reporting period that provide evidence of its existence before the year end. So that if it exists before the end, why is that we don't include it? Just that, we see it happen. It has not fully materialized. The transaction itself has not taken place yet. So there's no evidence of it. It has not given us any evidence for us to record, even though it exists. So until it shows itself fully to us and says, yes, now this transaction has, that's all. So it exists before the year end. That is what the adjusting event basically. Now, what is the accounting treatment of adjusting events? Accounting treatment simple means how are you going to treat such transaction? Tell the examiner that you are going to do what? Adjust. So the accounting treatment is just adjust the current year's financial statement. To reflect the impact of this transaction. That is accounting treatment. It simple means record it. That's all. So in 2019, the transaction will take place when? Maybe 2020 February. Kindly record it in what? 2019 financial statements. The immediate or the current financial statement that we have prepared. How to get it? Good. So that is the accounting treatment of the adjusting events. Now, it is your duty to know the examples of adjusting events. So we'll go through about 5 examples of what adjusting events. So 5. I'll give 5 examples. Anywhere you see them, they are adjusting events. So let's see. Basically, first example, impairment of assets after the reporting period. Shortly, the reporting period. If these figures have been included in the financial statement. So examples, let's come to our examples. Examples. Number 1, impairment of assets. After, in fact, all these examples, they are after the reporting period. After the reporting period. After the reporting period. Okay, so basically that is it. The transaction itself will take place after the reporting period, but it will give us some idea that it exists before the year end. Example is impairment of assets. So impairment of assets. Good. Now, let's give an example of this. After the reporting period, if you find out that one of your customers has been declared bankrupt, and this customer is owing you, let's say, 2,000 cedis, what are you going to do? If not insure this customer's debts, no. So that means this amount, you are not going to receive it. So this receivable has been what? Impaired, but it took place after the year end. However, because this 2,000 It's now receivable, it's in our balance sheet. There was an evidence that, or it's just an evidence that this 2,000 that is in our balance sheet has been impaired. We are not going to receive it. Have you get it? So therefore, we should include it. So if the owner says a question, and so a customer or a bad debt of this needs to be written off. That's an example of what? Event after reporting period, which is not just an event. So after the reporting period, if you receive a notice that either a customer or anybody that owes you, are not going to receive the money, but this money has been included in your financial statement as receivable. Kindly, what do? Take it off, and then that's all. Basically. Okay. Another example is sale of inventory below its current value after the reporting period. So that's the first example. The example is bankruptcy of a customer after the reporting period. It suggests that the debt has been impaired, so it must be written off. So after the reporting period, if any of the customers been declared bankrupt, we need to write off whatever amount that customer is owing us off. We need to adjust our financial statement to reflect the impact of the bankruptcy on our customer. Good. Another example is the sale of what? Inventory after the reporting period below its current value. If you sell goods or your inventory below the current value, what does this suggest? It suggests that we need to write off some part of it. In fact, all these two examples, they are sub-examples under impairment of assets. Yes, when you say impairment of assets, meaning we have an asset, any form of asset, it can be inventory, goods, it can be receivable, it can be cash, and then we're not going to receive or we're not going to recover the entire value. That means some part has been what impaired. That be good. Good. So that is it. So these ones are sub-examples. Sub-examples. How do you get it? So sub-examples of the impairment. The first sub is the bankruptcy of a customer. If they declare a customer bankrupt after the reporting period, whatever that customer is owing us, provided that that customer's amount is in the financial statement, not that the customer paid their 2020, and then around January 2020, they declared that customer for bankrupt. No. We are saying that in December 2019, that customer's money is inside our receivable, maybe 20,000. Our receivable is 20,000. That customer's own is 2,000. Then 2020 January, they declared that customer bankrupt. That is what we are talking about. Not that the customer picked the facility 2020 and then January 2020. But before we publish our financial statement, they declared that customer bankrupt. No, that one will not be part of what event after reporting. Why? Because that customer's amount is not in 2019 financial statement. Good. So that is it. And then sale of inventory. The second one is the sale of inventory below the current value. If you sell inventory below the current value, meaning that inventory has been impaired or it must be written down. It must be written down. If you dispose of inventory below the current value. Sale of inventory below the current value. Sale of inventory below the current value, basic value. Sale of inventory below the current value. Okay. Let's go to number 2. Example 2. Example 2 will be settlement after the reporting period of a court case. Settlement after the reporting period of a court case. So settlement after the reporting period of a court case. A court case. A court case. That suggests that the entity had a present obligation before the year end. Before the year end. So if there is ongoing litigation, and then shortly after the reporting period, but they've passed the credit, and then we have to make some payment to the court. This transaction is what an adjusting event, because there's an evidence that before December the court case is still in possession, or we have a pending court case. But December, we don't know the judgment. We don't know whether we are going to probably lose the case or win the case, or even amount that we are likely to pay as compensation. So after December, we have no idea about this information, so we're not going to record it. But right after December, let's say January 20th, they pass the judgment, and then we have to make some payments of, let's say, 50,000 cedis as a compensation for breaching some copyright information. So such payment becomes what? Adjusting event, because before the year end, the case was still pending. How we get it? Good. Example 3. Discovery or determination after the reporting period. Discovery or determination after the reporting period. Purchases or proceeds from sale. Before a year end. Before that took place before the year end. This one is like this. Purchases, that's discovery or determination after the reporting period. Purchases or proceeds from sale that took place before the year end. Okay. So discovery of goods purchased or proceeds from sale after the year end, but these goods or these purchases or these transactions took place before the year end. For instance, when we are collecting the end of the year's reports, we are going to add certain transactions to it because we couldn't find the receipt. The receipt was in someone's bag or someone's file, which cannot be retrieved. But shortly after the year end, we found all those missing receipts. So now, this transaction, we found the receipt after the reporting period, but the transaction took place when? Before the year end. We bought the goods, we made the payment, we received the money before the year end. Just that, as at the time that we're paying the financial statement, there's no proof, there's no source document, there's no evidence. And if we don't have evidence, we are not going to record it in the financial statement. We saw the evidence after the reporting period. So what do? You have to adjust the financial statement. How do you get it? So like invoice that were missing before the year end, that was found after the reporting period. So that is how we are going to treat it. So let's go to number 4. Example 4.
So you said you record it when you have the invoice.
Exactly.
So even if the transaction has taken place, the year on the
It's not being accounting books. Yes.
so you're looking at the faithful representation.
Good. It does not amount to faithful representation. That's why we don't have. So what happened is this: if the transaction takes place today and there's no source document, there's no evidence to back it, we are not going to record it until there's what? Evidence to back the recording. That's what we have what we call source document. So before we enter transactions in accounting books, there must be a source document. The source documents are receipts, invoice, paying slip, checkbook. All this one give us some sort of evidence that we standard in money, we receive goods, we pay cash, or receive money. How we get it? Good. So where we don't have evidence, we are not going to record it. Because we don't know the exact amount, we can't do guesswork. And public accountant cannot remember the exact amount from the invoice. If the invoice is missing, don't treat it at all until you find the invoice. How we get it? Good. So that is it. So later on, if you discover the invoice, then you have to go back and adjust the financial statements. Good. So that is it. Let's go to point 4. Point 4 is errors or fraud. That suggests that the financial statement is what? Incorrect. So errors or what? Fraud. So that one is material. Errors or fraud. That suggests that the financial statements are what? Incorrect. So errors. The fourth one will be errors. Or fraud. That suggests that the financial statements are incorrect. So errors or fraud. So that is it. So after the reporting, you realize that there's some mistakes that has been committed in a previous year's financial statement. But before you publish it, can you correct all the errors, correct all the mistakes, and correct all the fraud, adjust all, and make sure that your financial statement you're going to publish is what mistake free or fraud free. That is all. Good. These are some few examples that we have. Now let's see. We're going to back this with illustration, and then I'll add the fixed example. So let's quickly add the last one to it. The last one basically talks about the profit sharing or distribution after the reporting period, which is as a result of constructive or legal obligation or legal means. So let's see something here. Let's examine now. Profit sharing after the reporting period. Profit or sharing or any other distributions after the reporting period. So that could be profit sharing or distributions, any form of distribution after the reporting period. So profit sharing or profit sharing or any other form of what? Distributions after the reporting period as a result of what? Constructive or legal obligation. As a result of what? Constructive or legal obligation. As a result of constructive or legal obligation. Now, we are saying that if it is the habit of the company to be sharing part of the profits anytime they achieve their objective or their targets. Some company, the year that you achieve the target, they have to give their employees something. I've seen. Good. So they've done it consistently and it become part of them, their culture. So this time around, we are in December. If I achieve our target, what will the expectation of employees? We're waiting for what? The remaining what? Item 13 or the bonus. Are we saying? So that's one. There's an evidence that the people are expecting because that become your habit. Or the law impose it on you. That every time you sack someone from the organization, you need to give the person something. Take home or compensate the person duly. So the law imposes that liability on you. So that is all. So after the reporting period, if you pay such amount to the person, there's an evidence that this transaction exists before the year end. But before the year end, you don't make the payment, everything, so we can't report it. So that is it. So take note, these are the 5 examples of what? Adjusting events. So when this transaction occurs in the financial statement, we need to do what? Adjust the financial statement accordingly. Adjusting financial statement simple means record it, include it, reflect it, treat it, add it. That is all. Now let's go to non-adjusting events. Non-adjusting events. Number 2 is what? Non-adjusting events. non-adjusting events. Non-adjusting events. Now, the adjusting events provide evidence that they exist before the year end. But the non-adjusting, they also provide evidence that they exist after the reporting period. How we get it? For them, if this is December, this is our reporting period. This is January. This is March. Good. And then there's a material transaction that took place here. But it provides evidence that it exists after the reporting period. So if it exists after the reporting period, should you include it here? No. But adjusting events, even though it will appear here, it will tell us that, oh, for me, I exist before the year end. That is the difference. So non-adjusted events is an event after the reporting period that provides evidence of its existence after the reporting period or after the year end. So it's the same statement, just I change the word before to word after. That is all. Before. Yes, and adjusting provide evidence that it exists before the year end. And non-adjusting provide evidence that it exists after the reporting period. Good, after the reporting period or after the balance sheet date. That's all. Have you seen the difference? Yes. Good. Now, all what you need to know is only 3 items. Number 1, you know the accounting treatment. Number 2, you know examples. So when you see this example, then you pass by. See this example, then pass by. Okay. So that's it. Now let's look for the accounting treatment, and then we'll go to the examples. These are the examples are plenty. Accounting treatment of non-adjusting event. As the name suggests, non-what? Adjusting. And it does not provide evidence of its existence before the end. It's rather what? After. So if it is after, will it be part of this year's financial statement? No. So adjusting events, we do nothing. However, if it is what? Material, then we disclose. You do nothing unless it's what? Material. So the material one needs to be what? Disclosed. So let's see how we are going to disclose the non-adjusting event. So the accounting treatment is accounting treatment. So disclose all material non-adjusting events. So number 1, we do nothing. But if material, then we need to what? Disclose. Then disclose. Now, if I want to disclose, the standard gives us how it must be disclosed. That's all. The standard is saying that the disclosure simple means number 1, tell us the nature of the event. Disclose the nature of the event. So tell us the nature of what? The event. Number 2, tell us the financial impact or the effect on the financial statement. So the effect, the financial effect on the financial statement or the financial impact on the financial statement. That is all. So if you are disclosing now, oh, this transaction took place, but just that it's not the part of this year's thing because it's not adjusting. Share with us, relax. If the impact is that you could have reduced the sales by, let's say, 40,000 cedis, or you could have increased this one by this. That is all. Tell us the financial impact. That's the B. It's financial effects. So it's financial effects on the financial statement, FS. The financial statement. So which of the financial statement will it affect? Oh, it affects profit and loss, financial position, change limit. Good. That is all. So that is non-adjusting event. Then what levels we have to look for examples. So let's go in for more examples of non-adjusting events. Examples of non-adjusting events. I'll start with number 1, going concern threat. Number 1 is what? Going concern threats. Going concern threats. It's an example of what? Non-adjusting events. Examples of non-adjusting events. Going concern threats. What do you mean by going concern threats? Are you saying sometimes after the reporting period, you experience material losses, huge losses? Check 2020, between January to March, April, most company lost due to the COVID. Huge, massive losses. In fact, don't say that, oh, this loss, I'm going to add it to 2019 financial statements. No, don't do that. But instead, this is an example of going concern threat. This is not adjusting event. It has nothing to do with 2019 financial statement. There's no evidence that you're going to get this loss in 2020. Good. Instead, you prepare your financial statement on assumption that you have a going concern, right? Can you go back and go and change that assumption? So that one, you change the assumption from going concern to what? Breakup basis, that future is not certain. Your future is in doubt. So if you experience material losses after the financial balance sheet date, do not add these losses in the current year financial statement. Instead, just tell yourself that you don't have a going concern. It's likely that you may lose business. So therefore, change the basis of what? The preparation from going concern to what? Breakup basis. That is all. So the impact or the losses that you suffered should not be part of the current financial statement. Example 2, Almighty. I want to examine like also like this. But let me have this question before I'll chip it in. Let's assume that our financial year starts at January, obviously to end at what? December. We prepare the financial statements 2019, and then we organized our first AGM in 2022 to discuss the 2019 financial statement and performance. And that day, we have to also declare the dividend, the final dividend for 2019. So it took place on, let's say, 5th of, let's say, February. That is where we declared the final dividend. So final dividend of, let's say, 20,000 was declared. It's in respect of last year, 2019 financial statements. It's in respect of what? 2019. Good. Can we adjust the financial statements? Is it adjusting? Will it be adjusting event or non-adjusting? We have declared 2019 dividend in 2020 February. And then we declared it there. Will it be part? Should we add the 2019 financial statements? Or it should not be part, even though it is solely for 2019 financial year? Friends online. In fact, this is an example of non-adjusting event. Let's see why it's an example of non-adjusting event. Now, after December, nothing suggests that these people are going to declare dividend. Dividend is a matter of what? Policy. It is not something like constructive, where that one every year we must pay dividend. How we get it? So if something that is constructive or legal, every year you have to do it, or maybe every 3 years you have to do it. That one has become part and of you and habit. So people are expecting it. Good. So dividend, if you declare dividend after the reporting period, even if it's for this year, after before the year end, nothing suggests that you owe dividend. No. So we are saying that anywhere it's time to pay dividend for that particular year, that is all. How do you get it? So basically, That's how you're going to treat it. Company like Unilever, for some few years, they've not been paying dividend. About 5 years ago, they've not been paying dividend. Nobody will take them to court for not paying dividend. No. So nothing suggests that they are going to pay dividend. Dividend is a matter of what? Policy. Good. Because of this, examiners like this example, I'm doing my stuff. I also like it. So we see some. So dividend declared or proposed after the reporting period. So dividend declared or proposed after the reporting period. Okay, so let's back a report illustration. So let's all turn to success. Last but one footnote. So success. Last but one footnote. Success limited. Last but one footnote. Let me difference on my if I can detect it for you. Success footnote 10. The last footnote. It says like this. Our financial year is 31st March 2019. That's your financial statement. Apart from the interim dividend paid, which is shown in a trial balance about a final dividend of 3 pesos per ordinary share was proposed in April 2019. So that was proposed after the reporting period. How we get? Okay, so that is success. Very nice. So how do you treat the final dividend which was proposed or declared? So the last or the final dividend which was proposed or declared, how do you treat that one? The 3 pesos per share. You don't touch it. So that's all. So that footnote is not part if you touch it off. Because it's not an adjustment event. But the dividend in a trial balance, that's when you treat it, because that one was paid during the year. Just that the final one was declared after the reporting. So the final one becomes what? Non-adjusting. How do you get it? Good. So that's it. Now let's go to question 2, page 12. Let's go to notes.
Like in the profit and loss, we treat it. We treat it. No, I mean the dividend.
Yes, the dividend and trial balance, that one we need to account for it. Because that one took place during the year. So that one must be part of this year's financial statement. If you declare dividend within the year, it must be part of that year's financial statement. So dividend declared, normally around March there, or April, or June there, they will declare what you call interim dividend. They will pay that one. That one, it must be part of that year's financial statement. How do you get it? But the final dividend will be declared after the reporting period. And that one we are saying that one should not be part because non-adjustment events. How do you get it? Good.
So if the question reads that, apart from, okay, like saying that is what was paid.
So basically, that is it. Now let's move on to question number 3, and then you do it. I'll look at Ubuntu question 3 instead of it all. Question 2 is it all. You try it all. So let's move on to Ubuntu. Ubuntu is last but one footnote. Last but one. Look at the wording. I like the last footnote. So it goes like this. A final dividend of 50 pesos per ordinary shares was proposed by the board on 15th February 2019 In respect of 2018 financial year, the report for 2018, how we get it? So they proposed a dividend around 15th of February. And then look at the final one. This transaction has not been recorded. So what do you record then? You have to record it. This is what non-adjusting events. So but if declared or proposed dividend after the reporting period, you don't mean it inside. How we get it? The reporting period is 31st December 2018. So the financial year end at December 2018. If they declare dividend after the reporting period, it should not be part of it. That's basically. Okay. Okay, so we are done with the first two example. The dividend example, kind of look at it, most of the exam questions are in it. Most of the exam questions are in there. Okay, so let's go to other examples of non-adjusting events, the other examples. So number three, major business combination after the reporting period. Major was business combination. Major business combination after the reporting period. Major business combination after the reporting period. So it's also non-adjusting events. Like after the reporting period, Airtel and Tigo combine, Airtel Tigo, that one becomes what? Non-adjusting event. So major business combination. After the reporting period, this company acquired this company. Non-adjusting events. I will get it. Good. Yes, acquisition and levels, non-adjusting events. Major business combination after the reporting period. Major business combination. After the reporting period. Those are practical. Okay. Then we can also talk about a formal restructuring plan or a plan to restructure the organization. This also was non-adjusting events. If you are planning to restructure the organization, it is what? Non-adjusting events. Non-adjusting events. And natural disasters like unforeseen events after the reporting period. So all of them are what? So number 4 talks about a formal plan for restructuring after the reporting period. So after the reporting period, you are planning to restructure the organization. It is what? Non-adjusting events. Restructuring. Formal plan to restructure the organization. Then you can also talk about the uncertainties after the reporting period, like catastrophe. Earthquake destroyed one of your production plants, or fire destroyed some of the goods that you have produced. Even though these goods you have included them in the financial statement, this one becomes non-adjusting because there's no indication that fire will probably destroy all these things before the reporting period. How we get this? Good. So all these are what examples of non-adjusting events. So when you see this, get an examiner, this one non-adjusting event, then you move on. This one adjusting event, you adjust, non-adjusting, like that. Observe a nice example on the page. So I'll project it and then we look at it. Nice example. The drop 7. So let's look at drop 7. The one put it on the page yesterday. So now let's come to this. Major business combination. Major business combination after the reporting period. Okay, so drop 7. Drop 7. First, I'll go to the A for you. It's just explaining in line with IAS and event after reporting date. Explain what an adjusting event and non-adjusting event is after the balance sheet date, and show how each should be accounted for. Yes, we explain. Let's go to the B. Let's go to the requirement first. For each of the events described above, state if they should be treated as what? As an adjusting or non-adjusting event, and provide suitable reasons. Okay. Let's go to the main case. Papa Limited is a medium-sized trading concern. After the statement of the financial position date of 31st March 2015, so their financial year ended March 2015. But prior to the financial statement being authorized for issue, the following material events occurred. And that's one. It was discovered that the receivable balance of 12,000 existing at the statement of financial position date is uncollectible. How do you treat this? Is it adjusting or non-adjusting? It is adjusting. Good. It's an example of what? Impairment of assets after reporting here. So there's a receivable balance that you're not going to receive. They didn't give us the reason. As long as you're not going to receive this money, it is what? Adjusting. So you have to take it off from where? The current receivables and add it to our operating expenses. Because this is about it. It's migrating of goods.
It's subtracted from
Receivable and add it to operating expenses. That is the adjustment.
How do you go back? How do you subtract?
Okay, so if in the financial statement we have probably stated our receivable and our balance sheets, we've basically prepared the financial statements, and then auditors are doing their job on it. So current assets and the current assets, we have receivables. Whatever figure which is there, we have to go. And then if it is, let's say, 30,000, I need to take off this 12,000. So now our receivable have to go to 18. Again, if I go to my P&L, my operating expenses, I need to add 12,000 to it to increase it. That is the adjustment. How do you get it? You have to reflect the transaction.
So that means you need to.
Let's look at the many ones. The adjustment when you tell us. So, 2. Papa Limited has announced a bid to take over another company. Non-adjusting, a formal plan, a major business combination, formal plan of major business combination. Good. So 3, some material errors have been made in the preparation of the financial statement. Full stop. Let's discuss about that one first before I go to the second one. Material errors. Mistakes too. They have committed mistakes in the financial statement. That suggests that the financial statements are incorrect. So we need to correct all. So that one, they are super adjusted. That's Now, the second sentence suggests that a dividend of 20,000 was declared on May 5th, May 2015. So, good. The financial year ends when? March 2015. And it declared dividend when? May 2015. So it becomes to us non-adjusting. So in that sentence, half is adjusting, half is non-adjusting. Good. How do you get it? Perfect. Okay, let's go to note 4. The staff of Asambaba Limited have started a strike action for an indefinite length of time. Strike action. Adjustment, non-adjusting. Strike. Employees on strike. Is there any indication of their strike? Non-adjusting. In fact, non-adjusting events. Non-adjusting. Okay. Note 5. A public announcement in April 2015 of a formal plan to discontinue an operation which had been approved by the board in February 2015. This one, well, I now added one of the points. It is non-adjusting. So can we add it to it? A formal plan to discontinue an operation is an example of a non-adjusting event. Formal plan to discontinue an operation. If you are planning to stop running a certain product or service, after the reporting period, you make that decision. It was non-adjusting events. How do you get it? So that is it. Even though it was approved before the year end, it was approved in February 2015. It was approved in February 2015. And then the announcement happened when? In April. Announcement happened in April. So still non-adjusting events. Okay, let's go to note 7. Evidence. So you notice the settlement of an insurance claim for a loss sustained in December 2014. Good. This is what adjusting, because this settlement is to sustain a loss or to cover a loss incurred when December 2014. That is before our financial statement ends. So that becomes what? An adjusting event. Let's go to 7. Evidence that 20,000 cedis of the goods which were listed as part of the inventory in the statement of the financial position as of the 1st March 2015 had been stolen in April 2015. Adjusting or non-adjusting? They come and still some of the goods.
Yeah, it's not in 20. After the reporting year, so the 2 years.
Okay, so this is an example of impairment of assets after a reporting period. It has been impaired. Those goods, we can't retrieve them. It's gone. We can't retrieve these goods. So that's it. Adjusting event.
Adjustment.
Okay, so the last one. A sale of goods in April, which have been held in inventory after the 1st March 2015. The sale was made at the price below its current amount. Below the current amount. So adjusting events. Because there's an evidence that these goods have been impaired. And so, okay. Then on 5th of May, earth remove occurred and then it destroyed their main production plant. Adjusting or non-adjusting? Non-adjusting. Natural disaster. Earthquake. Good. So that is. On that note, we are done with. Let's look at IAS of income tax. Right after this standard, I will hand the baton to you to be doing the taxation or the tax issues coming. So that's so IAS 12, International Accounting Standard number 1. So It talks about income tax. Income tax. Income and tax. So income tax. That is all. Income tax. Okay. Now, when you mention tax, it's one of the necessary evils, right? Yes. Tax is just a compulsory payment from the citizen to the state without any return. It's something that you pay that you don't receive anything back. Yes. Basically, there are three types of taxes. Basically, some of them are direct tax. Some of them too are indirect. Now, and when you don't feel it, you don't even see that you're paying tax or you're paying. Now, let's look at some of the examples of direct tax. Sorry, the indirect tax. I'll do the indirect tax first. The indirect tax, you can also call it consumption tax. The person that consumes the goods or the service will be the person to pay the tax. That is it. Consumption tax. You can example include the VAT, the GET fund, and then the NHIS. All of these are what? Indirect tax. Then we can talk about the duties, all the duties. There are three. What are they? Import duty for importation, export duty, exportation. What about excise duty? That one is for locally manufactured goods. Good. So that's it. And many more. There are other examples of the indirect tax. A lot of them. Now, your examiner assume that.
Right. You did 10. Why not 11?
Good. We did IAS 10, in fact, we did IAS 2.
We did 2.
We did 2, and then 10, and then 12, right?
So why?
Good.
Why didn't I sequence?
IAS 3, that one cancel, 4 cancel.
Okay.
IAS 5 cancel.
Why?
IAS is cancel because they are out of date. Their requirement no longer apply. And then IAS 7 is the cash flow, but we'll do it later. IAS 8 is there. 9 cancel. IAS 10 is there. IAS 11 cancel 2018. So IAS 11 cancel. IAS 12 is there. 13 cancel. 14 cancel. 15 cancel. 16 is there. They should cancel all right. But if they cancel.
I'm wondering why I didn't know in sequence. Like, when they cancel, they'll bring another one.
Good. If they cancel, replace it. So if they are cancel all, that means they are going to replace what all. That is all. So it's not like they are going to cancel and then without making a replacement. That is it. Better one get very good though. Good. So that is it. So basically that is. Let's go to direct tax. And before that, I was saying that the examiner assumed that you've done VAT at the intro level and the financial accounting, VAT is in there, and the financial accounting, VAT. So the examiner assumed that when it comes to VAT, in fact, we're on top of it. So we will not do it here. Now, examples of direct tax. That's when the incidents cannot be transferred. Here, the one that's supposed to pay cannot transfer. Yes. Example is a payee. Because I cannot ask anybody to pay my payee for me. Listen. So tax is paid by what? Individuals. Then we can have corporate income tax or company income tax. The corporate tax, that's the CIT, corporate tax. It's just an example of what? Direct tax. Taxes paid by who? Companies. Then we can also have gift tax, property tax, gift tax. So please, when somebody give you a gift, kindly go to the tax authority and go and then Hannah and pay tax on it. Yes, so give tax. So kindly try as much as possible, and then you pay all your gift taxes. Yes. Then property tax. It's also an example of what? Direct tax, property tax. Property. So all the properties that you have, pay tax on it. And these ones are common. I also have what you call the tax on chargeable income. So capital gain tax. Anytime you sell something, you sell your building, your house, your car, any item at all, and then you made a profit, you go and pay tax on it. Okay. Yes. Your personal building. Yes, when you sell your car and then you made a profit on it. Okay. In short, we are not interested in all this. We're only interested in this. So IAS 12 is about the corporate tax, and so whether payee, payroll, gift tax, those ones are not part of IAS 12 requirements. So take note. Good. So we are going to single only corporate tax and then do that one. So IAS 12 basically talks about corporate tax, tax that are paid by the companies. Now, IAS 12 look at the accounting measure, not the legal measure. It means that the tax that we keep in our books is sometimes different from the tax that the right tax or the tax that tax authorities will declare or will ask us to pay. So you have a legal measure and an accounting measure. Good. So if you take the income tax expense for every company, how do you calculate it? That is all. So IAS 12 will teach us how to calculate the income tax expense and how to keep tax issues in our books. That is all. It's only in our book. It is not backed by any law. The IAS 12 requirement is a legal, it's just an accounting measure, not a legal measure. If you go to the tax authorities book, they are using the local legal laws. I get it. Not the IFRS. They're not going to use IAS 12 to determine your tax liability. No, they use what you call the Income Tax Act. Agreed. So to determine the income tax expense, that examiner, the income tax expense for every company is made up of 3 items: the C, the U, or the O, and then the D. That is all. If I add these 3 items together, it will give me the income tax expense for every organization. If I understand these 3 items, then we are done for IAS 12. So we take our time and go through them one after the other. The first one, if I put them together like this figure goes to the P&L as well, the income tax expense. So the income tax expense that you see is made up of C, U, and then D. So we call it CAD. The C represents current year tax provision. So that is on current year tax provision. You can also call it corporate tax provision for the year. Corporate tax provision can also be referred to as well corporate tax provision. Corporate, all of them that we will see. So corporate tax provision. Good. Now, if you don't see provision, you can also see this word estimate. They are the same. It's an estimate, not actual. Because you cannot determine your own tax. No. The law has not given anybody the permission or the chance to determine your own final tax. No. Provisional, well, we can allow you to determine your provisional tax, but the final one is in the hands of the law. Okay. Now, if you don't see current year or for the year, they will quote the year in question for you. to know that yes, this provision is for this year. You are done. Why is it an estimate? It's an estimate because after the time that we are preparing a financial statement, we're supposed to wait for the tax authorities to tell us the right tax so that we can clean it in, so our financial statement to be like conform with the reality. Okay. The same tax authority, they're also waiting for us for our financial statement. Scan through and also tell us our right tax. So now everybody's waiting for his friend. Now it means that we have to just key in a provisional figure, just an estimate for now, so that after they have scanned through, they will tell us the right tax. And that provision must be in line with IAS 12. So for instance, if our profit before tax is, let's say, 30,000, and then we are in a tax bracket of, let's say, 20%. If our tax rate is what, 20%, what will be our income tax expense? So you find 20% of our profit before tax. That will give us 6,000. That is all. So provisional, or in the meantime, let's record 6,000 and we'll give the account to them. Later on, when they assess the account, they'll tell us the right tax. We'll do the reconciliation later. That is all about the estimates or the provision. It is not the actual. Good. Now let's come to examination focus. In the exam, so where are you going to put these figures? In two places, that is all. Number one, it can be in the trial balance. It can be in the trial balance. Trial balance. So it should be in a trial balance. If it's in a trial balance, they'll call it tax computed on taxable profit or income tax expense. Just that if the examiner quotes income tax expense, I think they has already stopped it. So you normally tell you tax computed on what? Taxable profit. That is all. So take note. And if it's the trial balance, after you bring it here, it ends there because all the items in the trial balance need to be treated once. After bringing it here, you are done. That is all. So let's go to A12, question number 2. Scan to the trial balance. Question 2, A12. If you scan to the trial balance, you see tax computed on taxable profit, 18,000 in the trial balance. That's A12, question 2. If you check the trial balance, you see that there's 18,000 of tax computed on taxable profit. And that is it. So in that case, you can put 18,000 here from the trial balance. So 18,000. And that is all. It's not going anywhere again. You don't send it to the financial position and then that is all. Okay, I'm done with the trial balance. Number 2, you can also see the current year tax in the footnote. That is where they require a little or extra adjustment. So if it's in the footnote, it might be in the footnotes. 2 things will happen. You know, if it's in the footnote, it must be treated what? Mostly 2 times. So first, you add it to the current year tax. So if it's in the footnote first, you add it here. So add it to the income tax expense. IT, income tax expense. That's the first treatment. Second, have you paid this money? Have you paid this money? No. You have not paid this money. This money have not been paid. Because an estimate, right? You add it to your current liability because it's a mere provision. If not paid. However, if you have paid any of this amount during the year, can you take it off? If you have paid what? Any of this amount during the year, take it off. For instance, here you add it to the income tax expense. That's this side. Second, add it to your current liability because it's a provision. It's a liability to you. You are owing. However, if you have made any payment during the year in respect of this provision, kindly subtract it. How to get it? So let's assume subtract from the 6,000. Sorry, subtract from the provision made. So let's back with the illustration. Let's go back to our 30,000. This 30,000 is our profit before tax. Our tax is 6,000 provision. I have subtracted it here. Fine. This tax provision, sometimes you make quarterly installment before the actual tax. So during the year, I have to pay any tax to cater for maybe this 6,000. If yes, I'll take it off before I send the final figure to the current liability. For instance, during the year, they pay a total tax of 2,000 cedis. Okay, and you make a provision of 6,000, and I've already paid what 2,000, so I'm owing 4,000. So now my current liability, I'll only reflect on 4,000. However, if I have not paid any figure at all, then it means that I'm owing what 6,000. So the same figure comes here, and the same figure goes to the current liability. How do you get it? Very good. How do you know that you paid 2,000? It will be in the trial balance. So if you see tax paid, if you see tax what paid, it means that that is what they have paid during the year, and they will reflect the year. They will add a year to it for you. So tax paid during the year. Let's go to Ubuntu.
Yeah, in this one, I can see tax paid during the year, 12,000.
Okay, that's it was right.
Yeah.
Good. Tax paid during the year. Good.
And then you have a cost considered unfavorable.
Good.
In
it was the tax paid 12,000 was explained again in the footnotes. It was paid in respect of last year. So we'll probably come to that one. Let's go to Ubuntu. And I want to explain something there. Ubuntu. Ubuntu. Okay, so Ubuntu is here. Go to note 3. The note 3. Let's start from the second sentence. Note 3, the second sentence. Second sentence. They are saying that the corporate tax provision for 2018 is mentioned the year. 2018 is the year in question. It's 4 million, full stop. So that's the current year tax provision. So that is what 4 million, basically. Now, if you go to the trial balance, you can see tax paid on the trial balance. Let's go. Tax paid for 2018, have you seen? So they've made a provision of what? 4,000 for 2018, but they paid what? 3,000 already. So how much are they owing? They're owing 1,000. Go note 3. For 2018. But we are picking from the second sentence. The first sentence have an agenda. So the second sentence says that corporate tax provision for 2018 is what? 4 million. That is all. If you come to the trial balance, you can also see tax paid on the trial balance as 3,000, right? Okay, so out of the 4,000 provision that is made, they've already paid what? 3,000. And here you can see clearly they say paid for 2018. How do you get it? And the tax provision was also for what? 2018. So in short, in this case, all what we do is this. I'll come here and tell the examiner. The examiner, the current year tax provision should be what? 4,000. First thing. Because that's the provision that is paid. Whether they paid it or not, I'll put the 4,000 there. Second, when I go to my financial position, my balance sheet, I'll go to current liability and write tax provision. So out of the 4,000, have they made any payment during the year? Yes, they said they made what? 3,000. So therefore, the tax liability or the tax provision left for us to pay will be the 4,000 less any payment. So left with 1,000. If I should end here, 1,000 goes as for current liability. However, if the 3,000 is not on the balance sheet, or the 3,000 is on the trial balance, then that means the entire 4,000 becomes a current liability. How do you get it? Good. So basically that is it. On that note, I am done with the current tax, the current year tax provision. Let's go to the U or the O. We call it under or over tax provision. Under or over tax provision. So after the C, we go to under or over tax provision. Under you add, over you subtract. Let's explain. Now we said that the tax provision or the current year tax is a mere provision, it's an estimate, which definitely might be different from what? The actual. Who determines the actual? Is the tax authority. We don't have upper hand on our tax issues. So we can only make provisions, not the final. The tax authority, they are using what? The local laws. The company, we also using what? IAS 12, which are two different things altogether. So definitely, you might end up estimating different from what? That of the tax authority. So therefore, to know or to calculate the under and over, you compare whatever you provided and then the actual or the final one which has been agreed. That is all the difference. So first thing, the under or the over, I call it a tax reconciliation for the previous year. It's just confirmation for the previous year. So under and over is only for what? The previous year. So if I am in 2018, preparing 2018 financial statement, I can only confirm what? 2017. So I can only reconcile 2017's only. Because by the end of 2018, the tax authority will give me the final assessment for that of the 2017 financial year. Let's take the game. The under or the over, I can only confirm what? The previous year. That is all. So if I'm reporting for 2018, the under and over will be for what? 2017. If I'm reporting for 2019, the under and over will be for what? 2018. So now, check the year in question carefully. If the year in question is 2019, and then in the question they are giving you the year question is 2019, but they are giving you previous year's tax history or tax information, it just helps you to calculate what under or over. It ends there. Okay. So let's see how best we can calculate the under over. So the information must be picked from the previous year. So first, to calculate under or over, tell the examiner what's the tax provided for last year. So bring the tax provided so much. Compare it with the final or agreed tax. Final or agreed tax. Final or agreed tax. Good. When you compare these two, the difference is the under or over provision. So let's cite nice illustration here. Let's assume that you make a provision of 6,000 in the books. But the tax authority says, no way, the tax should have been what? 7,500. And you've agreed. You've agreed. So tell me, did you end up provided or you make over provision? So right here, will it be under provision or over? Okay, I can see over. But you pay more than, like the final one is more than what you provided. Okay, let me work the case. What if you paid final agreed and tax paid? If you've paid it, whatever they agreed on, that was have to pay. It's still what? Under, because you have provided lesser than the actual tax. So you tell the examiner, under tax provision, 1,000 what? So when you come here, you put 1,500 in and it ends there. How do you get it? So that's how you solve this. 1,500, and then we move on. What if here happen to be 8,000? We make a provision of 8,000, but the tax authority says no way. Our tax should be 7,500. We have what? Over provided. So over means when you come, the tax that we provided last year was more than we're supposed to. So it's a gain, it's a credit for this year. So now let's subtract it from this year's tax provision. How do you get it? If it is under, it's small, so let's top it up. If it's over, it was more, so let's do what? Reduce it. That is all. Okay. So basically, that is how we are going to treat under and over. Okay. Now let's see. Sometimes the examiner might include it in the trial balance for you. If you see current year tax in the trial balance, it represents under or over. How do you get it? If you see current year tax, it represents what? Under or over. Under means it's an expense, so it must have what balance? Debit balance. So if you see current year tax in the trial balance, at the debit side, it's what? Under. If it's at the credit side, it will be what? Over, because over means it's a credit to you. It's a gain or it's a loss to you. That is all. Now let's back this with what? Illustration. So let's go to success. And let's solve success. So now you're going to solve from debit side means under, and then the credit side means over. Debit side is. Now let's go to success. Now you're going to solve both current and under. I'll still come to the D. The D is the deferred tax. So let's go to success. And let's pick the tax. So for success, let's go to the footnote. Last but one note. Check the year in question first. The year in question is what? 31st March 2019. So that when I mention 2018 tax information, you know that it's for what? Under or over. That's what we have to do first. Okay. So let's see. First, let's start. It says that's note 9. The income tax of 12 million paid showed in the trial balance. The income tax agreed with the tax authorities and paid during the year with respect of what? 2018 year. While the tax provision was 11.5 million for 2018 financial year, shown in about trial balance. Full stop. So this one, will it treat under or over? Or is a current year tax? Good. This one, we are in 2019, but they are giving us information about 2018. So it's for under and over calculation. That's the first point to establish. Second, they made a provision of what? 11.5 million, 11,500. But the final tax agreed was 12. So therefore, it's under tax provision of what? 500. So let's go to the board and see how the presentation will look like. Okay. So basically, what we do is this. If you are calculating the income tax expense, as usual, write C, U, or O. So the C happens to be, but not be there yet. But here we've established the point that it is under tax provision. Open a bracket. Find the difference. 12,000 minus what? 11,500. So at the end of the day, you get what? 500. And that becomes So have you seen? So even if I cannot determine the current year tax, one they've given me, I'll put it there first. If you not go onto the balance sheets or the financial position, no left anywhere again. If you check the trial balance carefully, this figure must be in a trial balance. This 12,000 and 11,500, it must be in a trial balance. Let's check. You can see tax paid, 12,000 there. And then tax provision is also there, 11,500, right? So that's good. In events where these figures are not on a trial balance, that means you need to top it up. You need to add it to that of your liability. Okay, let's continue reading from the footnote. Now, the next sentence says that the corporate tax for the year is estimated at what? 11 million. Full stop. What is that one? Corporate tax estimated for the year. So corporate tax for the year estimated at 11 million. That becomes what? The current year tax. How to get it? So that becomes the C. So corporate tax C. That is on corporate tax is 11,000. So if I should end here, the income tax expense becomes what? 11,500. If I should end here, if I put the two together, and now we add. Again, have they paid this money? This 11,000? No, they've not paid this 11,000. So therefore, my financial position and the current liability, and to write tax provision. So tax provision of what? 11,000. The entire 11,000 they are owing. It ends there. How to get it? Good. So we are now the first phase. Like the last is the deferred tax, and that's all for income tax, IAS 12. Okay, so let's look at the deferred tax. Or you have to back it with illustration for me. Okay. And if I do one, you do one. You are trying to input two. So question number 3, no 3. Question 3, no 3. Let's see question 3, no 3. We are just looking at the current year and then over. So no 3. The last sentence is not part. So the last sentence of no 3, don't touch it. No, it's not there. Good. Like so in short, if we scan through this, there was a current tax of what? 4,000 and there was under of what? 500. And however, in the statement of financial position, how do you get a tax liability? The provision made was 4,000. You check the travel whether they've made any payment. They've paid 3,000 out of the 4,000. And then you put it there. So then you check whether the under or the over is on a trial balance. If it is not on a trial balance, then we have to add it, the liability to the company. Good. And then that is all. So in short, to stop this particular one, you know, the under or the over, it must be part of the trial balance because it's the previous year's balances. But if this balance has not been captured on the trial balance, then we have to capture it again. If we check its for or success, the under or the over information, the information that we can use to prepare the under or the over, it was a trial balance. So after determining the under over, it ends there. We don't need to reflect it again. However, in this question, if you check the trial balance, the 500 is not a trial balance. The 2,500 is not a trial balance. The 2,000 is also on a trial balance. I have to get this. So therefore, that 500 It's missing, so you have to account for it.
So you add it where?
You add the current liability because under you owe the tax authority a tax of 500 because of the movement. If this 500 happen to be on the trial balance, do not add it to your current liability. So let's see. The first, there's a tax provision of 4,000. Tax provision of 4,000. That's the first thing. There was under of 2,500 minus 2,000, and that gives us something like 500. So that is it. Second, when I go to my current liability, the tax bill as follows. Open a bracket. I'm owing 4,000. I've paid 3,000, right? But last year's owing, I've not paid that one. Plus what? The 500, and that's all. Basically, and then we add them basically, so 500. So let's take note. So this is what we go to the financial position, 1,500. I'll get it. Yeah, done. I know that the 4,000 minus 3,000 is a bit okay, but the addition of the 500 is the one that normally might create a little challenge. The challenge is that now we have paid the 2,000, which has been recorded nicely, but then the tax authority is saying that our tax liability is supposed to be what? 2,005. I can't see this 2,005 on the trial balance, so therefore the 500 left we are owing. We've not paid that one. We've only paid what? The 2,000. So let's add the remainder, this value to this. That should give us what? The ending balance. So we are done. Now,
the current year tax.
Now, before we start the deferred tax, that's the next one. There's an illustration in the material. And you have to try it for me. And then we'll look at it. That is the material on tax. That is the standard one. If you have the standard one in the standard one in there. So let's see the standard one. There's a particular example. There's a particular example before we study the deferred tax. Okay, so this example, target PLC, that's page 36. That's page 36. Target PLC. Can you try that one for me and send me your view about it? Target PLC, page 36. Target PLC, page 36. So I'm going to try that one under two scenarios. So this example basically talks about current year tax and then the under or over. Okay. So that is it. So you go to that one for me and then you are fine. So let's start with the deferred tax. The deferred tax. Because we said that the income tax expense is made up of three items: the current year, under, over, and then the deferred tax. You put these three together, that is all. Let's start with the deferred tax. While this example, so pending. Okay, so you mentioned that you need C so much, we need U or O so much. So far, it only tackles C and then the U or the O. And I'm going to look out for a deferred tax, right? That is all. Now, when you mention deferred tax, you need to do extra reckons on deferred tax. So this is the income tax expense. The tax expense should be like this in summary. Now, this deferred tax, you need to perform workings, extra workings on the deferred tax. So let's do it here. Third examiner, workings on deferred tax. In fact, here is the same as the workings that we did under the provision for bad and doubtful debts. That one too, bring the open balance from the trial balance, so much. Go to the trial balance. If you see deferred tax on the trial balance, it represents what? The open balance. Record it here, then you are done. Leave enough space here and come and write the closing balance. So put the closing balance here. Closing balance, so much. Then after relaxing for a while, they tell us how the movement. So the movement between the open balance and closing balance. So let's write here P&L. To be specific, we're going to what? Income tax. You put a difference here, the balancing figure. Then this figure is the one that we have come to what? This here, as it is, carry here. How do you get it? So as we treated the provision for bad debts, where we check the movement before we go to the operating expenses, the same thing we are going to do here. That is all. Now, this figure can be a non-current liability or non-current assets. So, but most of them is a non-current liability. No wonder on our balance sheet we add deferred tax to what? Non-current liability. That is it. We'll explain when it should be what? A non-current asset. Deferred tax can be an asset. We call it deferred tax asset. Okay. What happened is this. The open balance on the trial balance. This one, we have to find it in the footnote. Like when we give you this, we'll not give you this. When we give you this, we'll not give you this in that order. So let's assume that here happened to be 20. Open balance is 20. Closing balance, you have 35. What will be the movement? 15, positive. So here too must be what? 15. That is all. Good. Now, let's start with that of the closing balance. How to determine the closing balance? Very important. So we are going to learn how to determine the closing balance and some few definitions about the deferred tax. Good. Now, when you mention deferred tax, what is deferred tax? As the name suggests, tax which has been what? Deferred. This one, I'll partially agree, partially I'll not agree. Okay, let's see. Okay, tax that should be paid, but that's not paid. Okay, that's deferred tax because we have what? Deferred it. Deferred. To be paid later. Okay, to be paid later. In fact, these ones, they are alternative meaning of what? Deferred. The word deferred. Let's see the principle behind. Good. Now, let me clean all these ones here, and let's start with deferred tax proper. Deferred tax proper. The definition and its study. If we mention deferred tax, before I explain, let me use normal line. Let's assume that as at give us a balance sheet date, 31st December 2000 and let's say 19. I like 19. Yes, 2019, but 2020. Now, as at today, we are preparing a financial statement. Transactions and events already taking place, or even today. Transaction took place somewhere here, or at the date of what? The financial statement preparation. But this transaction, the tax effect will be in future period. Wow. Sorry, sir. Okay, so let's take this example. Assume that financial year end at 31st December each year. So as at 31st December 2019, a customer walked boldly to our shop to acquire goods, costing 10,000 or valued at 10,000 and promised to pay exactly 31st December 2021, 2 years later. And you know, tax authorities, they will tax us when we have received the money. They will not tax us when we don't have the money. So that we scratch our head that, oh, but this one, everything suggests that we've not received the money. Now it's unfair for them to ask you to bring money, but have not received money. Have you seen? Where will we get the money from? So let's assume our tax rate is 20%. 20, that's our tax rate. So the tax authority to wait. As soon as the customer brings the money, they'll be on our doorstep taking their share. So it means that exactly 2021 or 2 years from now, we are going to pay tax of what? 2,000 to the tax authorities. Agreed. Meanwhile, the transaction has already taken place in our financial statement. We have recorded the transaction in our books already. Just that the tax effect is in what? The future date. The tax effect is in what? The future date. I'll be getting it. Good. So basically, now, if 2021, you have an agenda, you don't know what to happen in 2021. So pushing today's expenditure to 2021 is something risky. In accounting, if you know there's a harm coming towards you, 2021, when they bring the money, I'll pay more tax. No, you've taken the account of the money already. You have added to your sales because the sales took place when? This year. Because there is an accurate concept. If you know there's a harm coming towards you, make adequate provision towards it. So we don't want a situation where we reach 2021, the tax authority will call us to come and pay this 2,000 and start scratching our head. That this money, we've taken record of it long ago. So what happened is this: why can't we make a provision in today's financial statement and defer the payment to later? So we have to bring this future tax forward in today's account or this year's financial statement and defer what? The payment. How do you get it? So I'll come and record a provision for deferred tax of what? 2,000. I'll ignore discounting. So 2,000 cedis. And defer this payment when? Into the future period. That's what I mean by what? Deferred tax. So deferred tax simple means is a future tax consequence or is an estimated future tax or consequence of transactions and events which has already occurred. At the date that we are paying the financial statement, that transaction has already taken place. Not future transaction, though. The transaction has already taken place, but the tax effect is in what? Is in the future. It can let us pay tax more or less in the future period. How do you get it? It will create what you call deferred tax. So tell the examiner, Mr. Examiner, deferred tax simple means transaction has already occurred, either this year or last year or previous years. But the tax effect is in the future period. So it will let us pay tax more or less in the future period. So the amount of tax we are likely to pay more or less in the future period is what we mean by what? Deferred tax. Abigail.
Can we add that as a result of value loss stage?
As a result of the different accounting treatments or different accounting bases, the tax authority uses cash basis. So when the money is being received, before they tax us. But we use accrual basis. When the sales being taking place, we record it in the books as sales, not when we receive the money. That is all. Okay. So basically, that is it. Basically. So that's the deferred tax. So now we know the definition of deferred tax. So deferred tax simply means an estimated future tax consequence, the tax effect of a transaction which has already taken place. That is all. Tax effect of a transaction which has already taken place. In future, not now. That is all. Now, when I mention deferred tax, there are two types of profit that come into mind. You should know all of this. There are two types of profit. We have what we call accounting profit and taxable profit. What's the difference? Accounting profit, I call it accountant profit, and taxable profit, taxman's profit. Now, accounting profit is a profit before tax determined in the accounting books by the company. Using what? IFRS. So we use IFRS. Is a normal profit before tax has been calculated? No, that's accounting profit. What about taxable profit? It's a profit determined by the tax authority after examining accounts using what? The relevant local tax laws, in which the company income tax liability to be based on. So your company income tax liability based on what? The taxable profit. Now we get it. These two profits, are they the same? Would they be the same? No. Because this one we use IFRS and other regulations. Taxable profit, they use what? The local tax laws. And these laws are not the same as IFRS. So basically, there is some difference. So what do you think causes the difference? And then we see. What do you think causes the difference? Causes of the difference. Now the causes, there are two types. We have the permanent difference, or the difference between these two. There are two. We have what we call permanent or difference. Permanent difference. And then temporal difference. That is all. Temporal difference. Now, the permanent difference means one-off transaction, which is allowed by one person and do not allowed by the other person. That's a one-off transaction. One party allows it, the other party do not allow it. How do you get it? So let's give an example. Some of the expenses that the accountant will include in the preparation of the financial statement, the tax authority do not allow. When they see they will not allow, they will not agree. Example, it includes what? Entertainment expenses. Any entertainment expenses incurred by the company, which has been included in administrative expenses, will be disallowed by the tax authority. But they are saying that that entertainment work can go on. That entertainment work can move on successfully. That is all. And it's not exclusively or necessary, because we use the three issues. Before we agree with that of expense, must be what? Necessary. Exclusively. Yes, and full. If not, we will disagree or allow. Another example of permanent difference is donation. Not every donation the tax authority will agree. How to get it? Not every donation. They only agree to donations that have what we call national character. Donation have a national character. I mean that donation will serve the interest of the state or the country. So for instance, if you want to donate to sport and go and donate to, let's say, Accra football, right? Such club, the tax authority will not agree, will not allow you to treat that donation as an expense, because it does not have what national character. You are giving it to just one of the football team. Okay, so if you want to give it to a football team, give it to a team that will what? Support the entire country. So Black Stars will agree. I have to get it. Or if you want to donate to a charity, donate to a registered charity in the district. Donate to what? A registered charity in the district before we will agree with your donation. So don't just go and then set up your own NGO and say that, okay, we've moved about 20,000 cities every month to this orphanage or this group as well for donation every month. Meanwhile, it's a personal NGO. If you have not registered it, you will not agree.
Is it recorded as part of our expenses?
Yes, you agree. You agree. So that is it. Now, the permanent difference does not cause deferred tax. No, it does not cause what? Deferred tax. permanent difference does not cause deferred tax. That one person agree, one person does not agree. That is all. What the accountant will accept, the tax authority will not accept. Or what the tax authority will accept, the accountant will not accept. So to create what you call permanent difference, the difference because nothing can like reverse it. You can't reverse permanent difference. Okay. Let's go to temporary difference. Temporary difference, the difference is what? Temporary for some time. What happened is this. This one, all of them see the same item, but the timing is different. These are timing differences. Let me give a critical example. The company's office building. Can the tax authority see the building as stones or as mountains? They don't see that building. The company also sees that building. Amazing. Unlike entertainment expense, that the company sees as expense, but the tax authority does not see that what as an expense. But building, some of the items, when they see here, this one will agree, this is a vehicle, this one is a vehicle. Have you seen? Good. But the timing, the years, maybe the company is saying that this vehicle should last for 10 years. The tax authority says, no way, this one should last for 5 years. We are done. So the timing is different. So let's see something here. And it's a temporary difference that causes or creates deferred tax. So let's assume that is the company book value, and it's the tax authority, we call it tax base. So there's a building here. The cost is, let's say, 50,000. And we said that this building will last for, let's say, 100 years. But the tax system, no way, this building can't go beyond that. Maximum that we can give is 20 years. Maximum. So they will accept the cost all right. They will see that building all right. But the years will be what? Just 20 years, which will affect the values, your depreciation value. So just 20 years, the building vanish from the books of what? The tax authority. After 100 years, the book, but the building also vanish from the books of what? The company. Is there any difference again? No, there's no difference. The difference is to just vanish. So tell the examiner that, Mr. Examiner, temporary difference, both the accountant and the tax authority see the same item, but the timing is different. The day that this guy is ready to see, this guy is not ready. The day that this guy is ready, oh, he has already recorded it, so he will not even make any difference. That is it. Unlike the permanent difference, that one, in fact, it's not like if I've seen it, I'll see my own tomorrow. No, I'll not see it at all. That is all. So that is it. So the temporary difference is just the difference between the book value or the current amount of an asset and its what? Tax base. So let me form a nice table here, and it's a temporary difference that creates deferred tax. Good. So I'll find a nice, we have what you call book value. We also call it current amount. Current amount. We also call it accounting base. Accounting what? Base. There's not like accounting base. And then versus what? Tax base. That is all. Book value or the accounting base or current amount means in the accounting books, what's the value? Tax base means how does the tax authority see the value? So we are saying that temporary difference is the difference between the current amount of an asset or liability and their what? Tax base. So how the accountant see that item and how the tax authority also see that item, the difference between these two values is called the temporal difference. How do you get it? So temporal difference is nothing but the difference between the book value and the tax value. That's all. So it can be an asset or a liability. So if it's an asset, let's say building. Current amount is, let's say, 300. But the tax authority says, no way, this building, the current amount should be 200. So what's the temporary difference? The temporary difference is what? 100. Agreed. Okay. Temporary difference is 100. So put it here, temporary difference 100. Now to get the deferred tax, I'll end at this. Deferred tax is equal to the temporal difference times the current tax rate, or tax rate subsequently enacted. So this is the balance carried down. Let's go to the deferred tax calculation. Here we have open balance from the trial balance. You leave a space, you go to the closing balance. The closing balance, you need to go to the footnote, go and pick the carrying amount of the assets, pick the tax base, and then find the difference. Then you multiply it by the tax rate to give you the closing balance. Then you now compare. Another we'll end here for today and then finalize it on next meeting. And next meeting, look for IAS 16. That's our next meeting. We're looking for IAS 16. So continue again and then solving more questions. On project wise, this is how far the good Lord doing that. So I'll end here. Yeah, that I'll continue right from here. That's next week. I'll pick this data and then continue. You can also be using the lecture material so that we can move in a bit faster. Good.